We talked in the first part of QuickBook projects on getting the company initially set up. Now our next step is to work with the chart of accounts and the company preferences. The chart of accounts is the most important step. You mess this up, you are going to have all kinds of problems. So be careful as you're doing this step. If you have questions about whether you're doing something or not right, you can call me, you can get a hold of the tutor, etc. Okay, so the first thing you're going to need to do is to go into, you're going to bring up QuickBooks, bring up your the company that you just created, and up along the top you'll see an edit. After file there's edit. Click on edit and then click on preferences and then click on accounting and then click on company preferences. And you want to, there's a box in there that says for adding account numbers. Now if you don't have this set up, then QuickBooks will just have the names of the accounts, and it won't have any account numbers. We need, once we're done, for our chart of accounts to look exactly like it is in your project instructions. So we need account numbers, and so here's where we're telling them, yes, we want account numbers. If your project has already given account numbers, you must use those, okay? Otherwise, if your project instructions doesn't have account numbers, you still need to use them, but you can use the suggested numbers that QuickBooks gives you. So they may call cash account number 10,000, okay? Whereas on your project instructions, it says cash is account 101. So we're first going to edit preferences to say, yes, we want numbers. Then QuickBooks is going to give us this 10,000 number, but we're going to change it to account 101. Okay, you're going to click on the chart of accounts icon on the navigation window in the company section. It's over to the right at the top. Or you can access the chart of accounts through the accountant button in the menu bar. There's various ways in QuickBooks to get to where you want to go. There's never just one way. So whatever is easiest for you, you just need to get to the chart of accounts. Once you're in the chart of accounts window, you'll see a button at the bottom and the left says account. So you're going to click on that down arrow and you'll see one of the choices is called edit account. Okay, and we're going to choose that. If there's an account in the list, you'll see a big box with a list of all your accounts that you have so far. And if there's one in there that you just need to change the number, the account number, or maybe you need to change the name. We talked in the previous video about maybe you had one that QuickBooks called it electricity expense, but you want to call it utilities expense. So now this is your chance. You can edit that electricity expense account and you can go in there and change it to utilities expense and put the correct account number in there so that both the number and the name will match what you have on your project instructions. Okay? There are some accounts where they'll allow you to put a beginning balance in there. If so, and you have a beginning balance on your project, if you have a post-closing trial balance or some other thing that lists out the beginning balances of different accounts, then you can go ahead. There will be a place that you can put it. You can go ahead and put it in there. Otherwise, don't just leave it. The beginning balances button blank, okay? Realize you may not see some accounts. So accounts receivable or accounts payable. If you previously set up customers, vendors, and beginning balances for those, then you automatically have an accounts receivable, accounts payable account. It may not show up on the screen that you're looking at, but it's there and you don't need to worry about adding it. If you did not set up any customers or vendors, and then you might need to go ahead and set up an accounts receivable and accounts payable account. Okay, but hopefully you did set up customers and vendors before you get to this spot right now, and then you won't have to worry about setting those accounts up. If you need to add a new account as opposed to changing one that's there, okay, let's say the supplies account, okay, which is an asset, okay, and so QuickBooks did not add it for us. So we're going to click on new account down there where it says account, down arrow and say new account. Okay, you'll have to know what type to choose, and we're going to go through all the different types here shortly. Okay, also you're going to put in the account number and the name. Okay, so if it's account number 120 for supplies, and you're going to put in the name supplies, remember that sometimes we can have a supplies, the asset, and a supplies expense, which is an expense account. When we first buy the supplies, we put them in the asset account. We own the supplies, they're on the shelf. But as we use the supplies, we do an adjusting entry, and that's when they go into supplies expense. Okay, so we need one of each. Okay, so if you need to delete an account, then you can click on, under account, you can click on delete account. And some accounts, QuickBooks won't let you delete. You don't want to use or delete the opening balances equity account. So let's say you had a beginning balance for your cash account. So you had already set up your cash account back when you set up the company, you set up the cash account and you told it, oh yeah, you know, we have $12,000 opening balance in this account. So as soon as you did that, you know, of course, from Accounting 101 that our debits always need to equal our credits. So when you put in a $12,000 opening balance in cash, that debited the cash account. Now it doesn't know what to credit. So it sticks it temporarily for right now in this opening balance equity account. And then once you get everything straightened out with all your chart of accounts and all the balances are where they need to be, then that opening balance equity account should be 0. There's some separate PowerPoints and videos about beginning balances. Okay. You're going to have to make sure every account you enter as a new account has the correct account type. Now, back when we were Accounting 101, we said there were 5 types: assets, liabilities, owner's equity, revenues, and expenses. Those are the 5 types that we talked about in Accounting 101. Well, QuickBooks wants to know exactly where to put a particular account on the financial statements. Does it go on the income statement? Does it go on the balance sheet? Exactly where? Does it need to be added or subtracted? And so it has this expanded set of types. So it's taken those 5 basic types and it's kind of pulled them apart into different type names that they use. Okay, so we have to know what their types are as we add these accounts in. Okay, so let's start with assets. Okay, and this slide is showing you what we learned, a review of what we learned back in Accounting 101. We learned that assets start with a 1. Their account number always starts with a 1. And they have a normal debit balance. Assets are what the company owns. such as cash, accounts receivable, supplies, prepaid insurance, equipment, furniture, vehicles. Inventory is also an asset. Assets are further divided into current assets or various kinds of long-term assets. So current assets are those that are either going to turn to cash or be used up within a year. So that's going to include cash is already cash. Accounts receivable, usually the customers are going to give us cash, pay us off within 30 days. So that's less than a year. Supplies, we don't sell the supplies, but we use them usually within a year. Prepaid insurance, we're going to use those insurance policies up within a year usually. And inventory normally gets sold within a year. So those are all ones that would be current assets. Fixed assets are things that we use longer than a year, and we're going to depreciate typically. So fixed assets are also sometimes called plant assets. Okay, and so we learned those would be the equipment, the furniture, the vehicles, etc. A contra asset is an asset that's attached at the hip to an account like equipment, but it has an opposite balance. So equipment is a regular asset with a debit balance. So a contra asset, such as accumulated depreciation dash equipment, is going to be attached to the hip to equipment, but it has an opposite balance or a credit balance. So we need to make sure that accumulated depreciation of equipment is put on the balance sheet along with the equipment, but that it's subtracted because it has an opposite balance. Okay, so that was what we learned in Accounting 101. Now, what about what we do with assets in QuickBooks? Well, first of all, anything that's a cash or a bank account in QuickBooks, they have a whole separate type called bank accounts. And so the savings account, the checking accounts, payroll checking accounts, all of those are all bank accounts, and we're going to put them, we're all going to call them bank account types. Now, for most of our projects, we only have one checking account, so we only have one bank account that we set up when we first initially set up the company. We've already talked about that. So you usually don't have to do anything with that one, unless you're adding later after you've already done that initial setup. If you're later adding a bank account, then you'll need to know to call it a bank account if it is. Accounts receivable has its own type as well, called accounts receivable. So it will automatically be set up when you set up the customers. And the beginning balance for the customers will automatically go into the general ledger accounts receivable account. So you'll be good to go as long as you set up your customers correctly in the first place. You will have no problems with accounts receivable. Okay. Supplies and prepaid insurance, these are other current asset types in QuickBooks. That's what you want to call them. Equipment and other fixed assets are called fixed asset types in QuickBooks, and accumulated depreciation is a contra asset, but they don't have a type called contra asset in QuickBooks. So you'll also put it in as fixed asset. But any balance, opening balance you put in will have to be put in with a minus sign to show that it's an opposite balance. So if you have $1,000 in equipment and $100 in accumulated depreciation dash equipment, you would put the equipment in there, call it fixed assets, put an opening balance of $1,000. Then the accumulated depreciation, you would set up that account, you would call it a fixed asset, but you would put a negative $100 as the beginning balance in it. Okay, that was assets. Now we're moving to liabilities. Back in Accounting 101, we said that liabilities are when we owe out to others, that they always start with a 2 on their account number, and that they have a credit balance normally. These kinds of accounts include account payable, note payable, bonds payable, wages payable, income tax payable, payroll tax payable, sales tax payable, okay? And most of them have the payable word in them. Means we have to pay in the future, means right now we owe out to somebody else. We also divided liabilities into current liabilities, which are those things we owe out during the next year. That would include accounts payable. Usually we owe that out in the next 30 days. And the various tax payables, income tax payable, payroll tax payable, etc., wages payable. All of those are due usually fairly shortly and quickly. So those are all current liabilities. Then we have long-term liabilities, which are due in more than a year. This would include a long-term note payable, like if we had a loan on the vehicle, 5-year loan on the vehicle, company car, that note payable would be a long-term liability. If we have bonds payable, those are long-term. Now, we might have a note payable that's like a 3-month loan that we have to pay back in 3 months, and so that would be a current liability. But most of the time, our notes payable are going to be long-term liabilities. Now, this was Accounting 101, what we learned there. Okay, now what about QuickBooks? So once again, QuickBooks has its own classification system for liabilities. It has its own accounts payable type, and again, if you've put your vendors in there and you put your vendor beginning balances, you've got them all set up correctly when you initially set the company up, then it has already set up an accounts payable account for you and put in the correct numbers. So even though you don't see it on the screen in front of you, it is good to go, okay? If you are not setting up vendors, then separately to keep track of each vendor's bills that you owe, then in that case, you will need to set up an accounts payable account, and then you'll go ahead and call that under type. You'll call that accounts payable as well. For the long-term notes payable, they use the loans type. And so here you have to click on 2 things. So for the type, you'll use loans, and then you would go in and say other current liabilities if it's due within the next few months, or long-term liabilities if it's due more than a year, such as a mortgage or a car loan. For other short-term payables, such as sales tax payable, you're going to first click on other. So you're not going to click on loans like you did for notes payable. You're going to click on other, and then secondarily you'll say other current liabilities. So for these, you have to click on 2 things. All right, let's move on to the equity accounts. In Accounting 101, we learned that they start with a 3 and they have a credit balance. For a sole proprietor, we have 2 equity accounts, the owner, capital, and the owner, drawing. Owner, capital is where we put the owner investments, and at the end of the month, we close out our net income into capital account. We close any owner withdrawals into the capital account. It's our one true owner equity account for a sole proprietor. The owner, drawing account is where we show any owner withdrawals, but at the end of each period, it's closed out to the capital account and starts next month at 0. The owner drawing account has an opposite balance, okay? So equity accounts typically have a credit balance, but the owner drawing account has a debit balance. So if you have a beginning balance you'll need to put in the minus sign. All right, for a corporation, for equity accounts, we typically have at least 3. We might have 4. We might have more than that, okay? So Each corporation has to have a common stock account. If it is a no par common stock account, then it will not have a paid in capital additional account. Okay, but if it has a par value, then the common stock will also have a paid in capital account. We might, in a corporation, additionally have preferred stock, and the preferred stock may or may not have a paid in capital account. All of these are for owner investments only. No net income is going to be closed into these accounts. No owner withdrawals are going to be closed into these accounts. Only owner investment goes into these accounts. That's it. Okay, then we might also have a dividend account, and this is where money is handed to the owners. Now, we don't call them owners, we call them investors. So if you invest into General Motors stocks and General Motors gives you a dividend, that's you getting an owner withdrawal. And just like owner withdrawals for a sole proprietor, it's going to have an opposite or debit balance. Whereas common stock and the paid in capital, preferred stock, all have a credit balance. The retained earnings account is in a corporation that's where we close stuff out to. So we close the net income into retained earnings, and we close the dividends, which is the owner withdrawals, into retained earnings. So the retained earnings is the closeout of all our net income since the beginning of the company. And it normally has a credit balance. All right, what about equity with QuickBooks? It has its own classification for equity accounts, but be sure to keep the opening balance equity account separate. Don't use it. By the time we get done with the chart of accounts, you want that balance to say 0, but until then, you just don't touch it for right now. Okay? If you have a sole proprietor and you have a capital and a drawing account, the QuickBooks will show an owner equity account, and you will click on that and put in the owner's initial, comma, capital, and to change that name. For owner withdrawal account, you'll go, QuickBooks has an account called owner drawing, and you'll click on that, you'll say edit account, you'll change it to the owner's initials, comma, drawing, okay? And if you have any balance, you need to make sure to put in the minus sign. Okay, for common stock accounts, you may need to create new accounts. Retained earnings, you'll use the owner equity, change the name to retained earnings. For dividends, you can use the owner drawing account, change the name to dividends, and remember to put a balance in as a minus sign, opening balance. Okay, the next type of account that we talked about in Accounting 101 was revenue accounts. This happened when we sell stuff. Whenever we sell services or sell products, that's going to involve a revenue account. Now, in QuickBooks, they're called an income, which is another name for revenue account. Revenue accounts start with a 4 in their account number, and they typically have a credit balance. We can have contra revenue accounts, such as sales returns and allowances and sales discounts. So they'll still start with a 4, but they will have an opposite or debit balance. Okay? If it's a service, there might be something like service fees, mowing fees, consulting fees, art fees earned, might be the name of the income or revenue account. Sales, the word sales is usually the name of the account when we're dealing with products. For QuickBooks, they use the term income for revenue accounts. And you're going to use income for all revenue accounts and contra revenue accounts. You just have to remember that the contra revenue account has to have a minus sign if they have an opening balance. Cost of goods sold. Back in Accounting 101, we talked about them as being a separate form of expense account. They start with a 5 and they have a normal debit balance like all expense accounts do. They are typically used with merchandisers and manufacturers rather than service industries, but that's not always the case. A service industry can have a cost of goods sold account. Okay, you learned in Accounting 101 about the cost of goods sold formula. This is what you're supposed to have under your pillow, and you're supposed to be saying it every night. Okay, beginning inventory plus net purchases and freight in is the cost of goods available, COGA. Then you subtract out ending inventory to get cost of goods sold. We had another formula. The gross profit formula is net sales minus the cost of goods sold, and that gets us gross profit. Gross profit, also known as gross margin on the income statement, extremely important number to investors and creditors. So that's why we want the cost of goods sold to be separated out from other types of expenses. There are two inventory systems in common use, the periodic inventory system and the perpetual inventory system. Periodic inventory system means we're not tracking the inventory. We're going to debit purchases whenever we purchase inventory for resale. Usually small local companies will use the periodic system. Okay? Perpetual inventory system means we are tracking the inventory item. So every time we purchase inventory, we're going to debit inventory. And when we sell inventory, we have to figure out how much did that inventory that just sold, how much did it cost, and we're going to credit inventory. Okay, so we're going to, as inventory comes in and out of the store, we're going to debit and credit inventory. Okay, whereas with the periodic system, we just debit purchase when we purchase the inventory, and we don't calculate out cost of goods sold till the end of the month. We got to physically count the inventory and then calculate it using LIFO or FIFO. If we're on the perpetual inventory system, we have to calculate out LIFO or FIFO every single item we sell. It has to be calculated using LIFO or FIFO, or average cost, that we learned about also in Accounting 101. Now, QuickBooks is set up that it will figure that out for us if we're on the perpetual inventory system. Okay, so in QuickBooks, the cost of goods sold accounts have their own type. If you are adding a cost of goods sold account, you click on Other and then click on Cost of Goods Sold. QuickBooks and other general ledger software packages are set by default to perpetual inventory system, means we're going to keep track of inventory, but we can use a periodic system like Project 2 and Project 3 uses them. Periodic system, we just have to make sure we set up those correct accounts. So in the periodic system, you're going to set up purchases, purchase returns and allowances, purchase discounts, and freight in are all accounts that are used in a periodic system. But you'll also call those cost of goods sold. Okay, for the perpetual inventory system where we're actually going to track the inventory, you're going to set up an account called cost of goods sold, and we'll use that for Project 4. Other expenses can start with a 5, a 6, or 7. And typically at a normal company, if it starts with a 5, that's typically a cost of goods sold type of expense. If it starts with a 6, that's a typical what we call operating expense, such as wages expense, utilities expense, rent expense, etc. Or if it starts with a 7, that is a, quote, other expense, and it shows up at the bottom of the income statement. Okay, for our purposes, you know, we'll have some very simple companies, and so they might just have a 5. It starts with a 5 for everything, just like we did in Accounting 101. Okay, but you may see some that have a 6 or a 7 in them. and especially project 4. Expenses, so these operating expenses all have a debit balance. Expenses are when we use something like rent expense, when we use office space, wages expense, when we use employees, utilities expense is when we use electricity, okay? Many expenses have the word expense after them, so that makes it a little easier to find, to see what it is. For expenses that are not cost of goods sold type of expenses, in QuickBooks, we need to click on the word expense instead of cost of goods sold. If they are cost of goods sold, you're going to click on other and then cost of goods sold like we said earlier. Once you finish inputting your account, so now we put in our assets, our liabilities, our equity accounts, our revenue and expense accounts. We've made sure all the names of the accounts are correct, all the account numbers are in there correct, and all the beginning balances are in there correct. Okay, you want to click on reports and print out the chart of accounts, which in QuickBooks is called the account listing. You want to double check the report. Are the assets in the assets section, etc.? Do all the accounts have correct account numbers? Carefully go through each account and account type and make sure you have them correct. If you have no beginning balances for anything, which is like a project 1, you don't have any beginning balances, you are done at this point. Okay, if you do have beginning balances, you need to check those, and you need to see that your opening balance equity